But joining us on the show today to answer all your personal finance queries is Feroze Azeez, and for the stock queries we have Ashish started. Good afternoon, gentlemen. Welcome to the show. First up, we do have our first caller, Seema Choresi, calls up from Mumbai. Hi Seema, can you hear me?
सर मेरा क्वेश्चन ये है, मैं पनवेल से बोल रही हूँ। माथेरान रोड पे मैंने एक 1 BHK का फ्लैट देखा है रीसेल का। बिल्डिंग जो है 12 ईयर पुरानी है। मैं ये जानना चाहती हूँ कि अगर वो इस टाइम मेरे को 20 लाख में पड़ रहा है तो आने वाले 2-3 साल में मुझे वहाँ से क्या बेनिफिट्स मिल सकते हैं?
Okay, Feroze, so I'll put that question across to you. What exactly is your view on this one?
Yes, in my opinion, firstly, very important is the asset allocation of how much money do you have in real estate already. Okay, it's been seen. The interesting fact is that Indian markets, the HNIs or investors, retail investors, have skewed their portfolios significantly to the real estate space. And numbers globally are about 30% gets into real estate, but for an Indian, more or less, the number looks like about 70-80%. As long as the investment in one specific asset class is less than about 40-50%, then you're fine evaluating a real estate investment. Then coming to what should you see in a real estate investment before you jump in, looking at the contemporary situation, the interest rates are not headed southwards like they were envisaged by the market in the recent past. So that's going to be a negative for real estate. That's one thing which you should consider before you get into real estate as an investment. The second point which needs to be considered, especially when you're investing in these peripheral cities, the satellite towns in and around the major metros, is the fact that the investment demand is the higher portion and the consumption demand is lower. So you're better off having a ratio skewed towards consumption demand. So that's one point you should consider. The third thing is the price movement over the last 2-3 years has been significant in and around Mumbai. So I personally believe that there could be a time-wise correction in the prices, if not a pure play price correction in the market. So unless you are able to move your investment time frame to 5 years plus, I think you should stay away from investing in the peripheral cities around Mumbai. That's my opinion. So recommendation is, if you can move your time frame from 2 to 3 years to 5 years, then I think it's a wise investment to do. Otherwise, I think you should stay away in these uncertain times. Yeah.
All right, Seema, I hope that answers your query. Also,
But moving back to our viewers who have written in, Meenal Shah has sent us an SMS from Bhopal. She can invest 12,000 per month, and she wants to know which is the best way to allocate her funds. Feroze, over to you. What do you advise her?
Yeah, I would advise her that considering that she has 2 children, which she has specified in her SMS, young children. So I would first try to assume that her investment time frame would be around 8 to 10 years. If you look at an investment period of 8 to 10 years, and it's very critical for you to beat inflation by a handsome margin. So you should look at generating about 13 to 14% IRR, which is nothing but the annualized rate, which you should target. So the following allocation, to my mind, can actually get you there. The allocation would be such that you have 50% of your money, which is the 12,000 rupees, invested in the domestic equity, which is the Indian equity 50%, 25% into Indian debt, and 25% into a global feeder fund would be the ideal mix, which can help you achieve a 13-14%. Now, getting a little more specific in terms of which schemes should you look at to do an SIP of this 12,000 rupees a month, I would suggest on the debt side, the Indian debt side, you can look at an SBI income fund where you can put 3,000 rupees, which is going to be 25% of your exposure. Then coming to the Indian equity portion, that is, you can split this into 2 funds. One is the large cap fund, which will be the UTI opportunities fund, and the mid cap space, you can look at an HDFC mid cap fund, each with a 3,000 rupees. And then moving on to a global feeder fund, which will give you the dollar exposure. Today, having dollar exposure, it's imperative that it makes sense. So if you look at Franklin US opportunities fund with 3,000 rupees, I think this combination of 4 funds will give you the right exposure. Very importantly, you should, to keep yourself motivated to put this 12,000 through the entire 8-10 year period, it's very important to understand what kind of monies can you accumulate. You will be able to accumulate 30 lakh rupees over the next 10 years for this 12,000 rupee per month investment. If you scale it up by 1,000 rupees, you will be able to get your maturity value up by 2.5 lakhs for every 1,000. So this will keep you motivated to keep this investment on for the rest period. So that's my recommendation.
all right, Meenal, I hope you were listening to that. Also, we have a personal finance query now. Divya Shah calls in from Mumbai. Hi, Divya. Okay, we believe, okay, we've not managed to connect with her. So, Feroze, let me read out Divya's question to you. She says that they've been approached by a finance company who's charged a fee and promised a very attractive return, but later there's no sign of either the agent or, that company. And, this is a query actually, which is not, like Divya is not alone in asking this question. There are a lot of people who are facing fraudulent agents like this. What does a person do?
Right. To my mind, when you're dealing with these fraudulent companies, you need to keep one thing in mind is the benchmark return. Any supernormal deviation from a benchmark return is a very large sign of it being a fraudulent or a false promise. So if, for example, if somebody is offering you a loan at rates like 10%, 11%, when the benchmark rates are about 13, 14%, then you need to be worried and try to be more skeptical and do your due diligence further. Understanding which company are you dealing with, which most of us fail to do, you have to ask the relevant questions of what is the ownership pattern of the company. Is it publicly listed, privately held? Is there any regulator to that company, RBI, SEBI, or any other regulator? If it's an unregulated entity whom you're dealing with, you need to find whether there are any sister concerns which have any regulation. Take the reference numbers of those regulatory bodies. Make sure that the employee you're dealing with, you need to have his employee number. Always, the next point is always propose to the person whom you're dealing with, saying that I will give you the fee after the transaction is complete. Most genuine companies would not have a problem with this arrangement. Okay, somebody who's actually having a problem with having a back-ended fee to the completion of the transaction is a sign of a fraudulent company. Lastly, in my opinion, the greed factor is what everybody plays on when they're trying to actually give you a false promise. So don't let greed take over your financial decision. If there is a bond which you're getting for 13, 14, 15% corporate FD, you need to be very skeptical because the risk-free returns are at 8.5%. So there has to be a significant default risk, which would be there in an investment which gives you 14, 15%. So greed, cutting greed when taking financial decision is the key message which I would like to give when you're trying to cut out these false promises and these fraudulent companies. That's my opinion.
And Feroze, also in a time like this when markets are doing so badly,
right.
Indians have these two favorite investments, like we were talking about gold, real estate, but gold prices are once again on the rise. It's above the 30,000 odd mark. Where does a person actually put their money?
Correct. When you rightly pointed out that gold and real estate are our favorites as Indians. Gold, of course, has come back and bounced back to 30,000 levels, but that's largely supported by the rupee depreciation. If you remove the froth of rupee depreciation from the gold prices, the gold would be at 23, 22,000 kind of levels, because you've had from those September 2011 levels, there has been a depreciation of rupee from a 46 level to a 62 today. So if you remove that from the gold, and you're speaking about of 23, 24. Then coming to real estate of course is one of our favorite asset classes. But if you look at asset allocation is very critical, because real estate over the last 10 years has in different pockets given returns of 400-500% from 2003. But on the contrary, equity, large stocks, good stocks are available at 2003 prices. So you need to make sure that which asset you have made money, you sell that out, portion, book your profits, get into the other asset class which has not rallied. So in my opinion, rebalancing from real estate to equity is the need of the hour, because it's both are completely on a disparity in terms of their relative valuations of history.
Yeah, so gold and real estate, everyone's favorite, but interesting to see whether the money continues to flow there given the kind of carnage we have seen.